Welcome to the next episodes of Debt Talks, a series by the Private Debt Initiative of the Institute for Neo-Economic Thinking. I'm Moritz Schularick, a fellow of INET, and I'll be moderating today's event. Today, we want to talk about the case for household debt relief. Household debt in the US has risen by a factor of 4 over the past decades. After the global financial crisis, the household debt to income ratio peaked at close to 120%, up from 30% or so in the 1950s. Household balance sheets have been transformed as a result. Debt, if we can say so, is everywhere today. And it needs to be serviced, even if income fluctuates, as in a recession. Debt is rigid and this has important consequences for the way our economies function and what policies make sense to help households in bad times. We also want to talk about the broader picture. A decade ago, Raghu Rajan's book, Fault Lines, popularized the view that higher debt and rising inequality are two sides of the same coin. Households with stagnant incomes relied on debt to finance consumption, whether out of sheer necessity or to keep up with the Joneses. At the top of the income distribution, incomes were going nicely, at the bottom, no longer. So maybe household debt relief cures a symptom, but not the disease. And when we're talking about disease, we cannot forget about COVID. We all hope it's over soon, but there's still a lot of suffering out there. And we want to understand better what debt relief can do this very moment to improve the lives of people. To discuss this today, we're so lucky to have 3 amazing guests. Professor Johnna Montgomerie, Professor of International Political Economy, Head of the Department of European and International Studies at King's College London. Welcome, Johnna. Very happy to have you here. She's the author of Should We Abolish Household Debt? That's the title. We have Professor Erica Jiang from the UC Marshall Business School. She's a professor of finance and the author of Government and Private Household Debt Relief During COVID-19, a fantastic paper that got lots of media coverage in recent months. And we have Professor Jialan Wang, I hope I pronounced that correctly, Professor of Finance at the University of Illinois, Urbana-Champaign. She's written very fine papers, one on the economic consequences of bankruptcy reform, and also has a great paper out about COVID. And we also look forward to hear what she has to say. We will start as usual with a round of introductory statements and then move on to discussion. To keep it lively, I will weave in Q&A from the audience. And please submit your questions anytime by clicking on the Q&A button. Okay, let's get started. I want to start with Johnna. Johnna, for many families, it's hard to make ends meet, and you have also the perspective from across the Atlantic, from Europe and the UK. Families struggle, and you argue that debt growth is part of a broader picture of rising inequalities, and we need to think very fundamentally about the case for household debt relief at this juncture. So why do you think that debt relief and not other policies such as income support are the way to go and are what's needed here? Johnna.
Yeah, no, and thank you very much, Moritz. And I'm very, very grateful to be here and discuss with my distinguished colleagues. I think the real point about the kind of the chronic condition, if we stick with the kind of COVID theme and the shock that we're enduring now, and remember the kind of pre-existing condition, which was this debt-dependent growth in the United States, in the UK, but abroad, the kind of Anglo-liberal model. That debt dependence is, again, what formed the 2008 crisis, again, to remember those long past days. And ever since then, we've had a series of measures seeking to, continually keep this, it seems like a very permanent state now of crisis, to keep a system going that is still dependent on debt. So debt relief allows us to, break again these ties. It's become, the financial crises are becoming ever more severe, and COVID promises to last for a long time in terms of economic recovery. By focusing on household debt, those people that are already struggling, and those that might not have had any problem with debt until COVID happened, by targeting relief at debt claims, what we do is we give people more access to the money and the income that they already have. Debt exists as a pre-emptory claim on income. So we give them relief, right? We just give them more access to their own money that they have instead of, these very persistent claims. So the idea here is number one, to allow households to have access to low interest rates. Again, these low interest rates is what allows wealthier households to borrow cheaply and gain wealth gains. Giving everyone access to low interest rates will generalize its benefits. So I think that's a really important way to think about combating inequality, to harmonize and allow individuals to have and households to have access to historically low interest rates. But also to think about the debt that has been incurred in the past 12 months, the emergency debts that people have had to take on. May they be health related, and all the consequences, not just of hospitalization, but recovery, and or be they income loss or for small businesses, revenue loss due to closure. And think about using debt cancellation in that way to specifically target those debts that were incurred because of this emergency as a means to provide relief. That can be more equal in the sense than just simply income support or employment insurance, as we've used in Europe. It gives us another lever to pull that will allow us to generalize relief, but also target those that are the ones that will inhibit recovery, as it were. The indebted are the ones that will hold back any attempt at economic revival. Thanks.
Well, thank you so much, and Johnna, for this, and Erica, fantastic. Thank you so much for being on this. I want to pick up on this, what Johnna just said. Debt relief being more targeted, being more specific, possibly being even quicker than traditional ways of doing macroeconomic stabilization policies, income support, stimulus. Let's stick with this for a second. Looking forward to your introductory statement, but maybe COVID-19, what have we learned about debt forgiveness as a tool to stabilize and help households in times of need? Erica, please.
Yeah, thank you, Morris, and I really appreciate this opportunity. Happy to be here. I guess I want to start with the statement that debt relief is especially important during crisis periods as a tool to stabilize the economy, and as what Johnna talked about and as your question. So I think the benefit of debt relief may seem very obvious to many people, right? During crisis periods, we often have significant household debt distress, and which then spills over to the rest of the economy. And debt relief programs that temporarily suspend debt repayments can then result in huge welfare gains by preventing costly foreclosures, like what Johnna talked about, and also providing consumption smoothing benefits to households. So I think that is one of the key, benefit of debt relief during crisis periods. And that is also what happened during the COVID-19 pandemic. And I'm happy to talk more about, what exactly happened in the US, after we finish this question.
Great, thank you so much. I'm hearing we have a little bit of a technical issue. There's a camera that crashed and needs to be reset and restarted for Jialan. So we're gonna have Jialan join us in a second, unless are you on? Can you hear us, Jialan?
I'm on the phone, so I'm happy to discuss.
Fantastic. That is good. So, the amazing INET team has found a work around that. Maybe we get to see you on camera in a few minutes as well, if this works. Jialan, we've heard what Erica and Johnna have said. There's been a lot of interest in consumer debt relief in recent years, both academically and on the political, on the policy side. Can you tell us why? What is the big picture here? Where's this interest coming
from? On bankruptcy?
Yes.
So this is a fascinating history that, of course, relates to Elizabeth Warren and Joe Biden back when they first met was during the 2005 discussion of bankruptcy reform in America. And back then, basically, Elizabeth Warren was championing greater bankruptcy relief for households. But what ended up being passed, and Joe Biden was a champion of the sort of pro-creditor side, that we ended up making bankruptcy much harder in the United States. And the 2005 law change cut bankruptcy rates in half. And the timing of it was very interesting in that it happened, of course, right before the Great Recession. And so a lot of households, and even though the law was attempting to discourage bankruptcy, a lot of households became into distress, and we saw bankruptcies rise nonetheless, despite there's law change. And of course, now here we are in another crisis. And the Biden, President Biden has adopted Elizabeth Warren's plan as a very ambitious plan for reforming bankruptcy once again.
Let's stay with this for a little bit longer. Erica, what have we learned from the relief operations during the COVID pandemic? Can you help us, and how does that fit into the picture of political or policy plans to deal with the broader issue of household debt, over-indebtedness possibly in the US?
Yeah, of course. So as I said, this is what happened during the COVID-19 pandemic. An important part of the CARES Act was about debt relief. So according to our estimation, there was $2 trillion worth of loans that entered forbearance by the end of October 2020. And that has an average accumulative payment per individual of more than $3,000 in mortgage and more than $400 in auto loans. And based on our estimate, more than 60 million borrowers missed about $70 billion on their debt payment by March this year. And so it seems that the debt relief programs reduced the debt default significantly. And as a result, the debt delinquency rate actually dropped below pre-pandemic level. And the high speed of debt relief in response to the pandemic likely dampened the economic damage of pandemic by preventing, costly foreclosures and potential spillovers to the rest of the economy. And then when we dive deeper and look at who benefits from the forbearance program, we found that it is true that individuals with low incomes are more likely to enter into forbearance, but we also found higher income individuals receive more relief in terms of dollar amount. Right, so this is partially due to their higher debt balances before the pandemic. And I think this is very related to Johnna's point that this is what make debt relief programs different from other income support policies like stimulus checks. The beneficiaries of debt relief programs are the individuals that already have outstanding debt. So high-income homeowners instead of low-income renters benefit more from such programs. Right, so that is one major funding of the work that Moritz introduced at the beginning. And I do think at this stage, a potential concern is, with this huge amount of delayed debt payments, are we able to have a smooth transition to post-pandemic recovery when the forbearance program ends in a month or so? Right, so one important lesson we learned from post-pandemic recovery, one important lesson we learned from the Great Recession was that institutional frictions of financial intermediaries that service the loans actually matter a lot for things like mortgage modifications and restructuring. And I do think this is more of an issue this time compared to the Great Recession, because banks are no longer the main dominant players in the consumer credit market. And what we found is non-bank financial intermediaries, we also call them shadow banks, they actually service more than 50% of mortgages in the US. Right, so those intermediaries, I don't know if how many of you are familiar with those intermediaries, they do not have stable deposit funding, and they do not have enough capital to absorb those losses on delayed payments on the loans they service. And therefore, they're less likely to supply debt relief than traditional banks, and many of them have already lost a significant amount of capital by the end of 2020. So I guess the question I have is, do they actually have ability to modify mortgages after year-long forbearance programs? And what we know from the Great Recession was lack of modifications do lead to slow recovery. Right, so I think that is my view. My view is that this type of ex-post debt relief has its merits and shortcomings. And the merit is it is calibrated to the specific realization of economic risk. Right, but the shortcoming is also very apparent. Is ex-post debt relief is also subject to those various implementation frictions, and which may reduce the effectiveness of other policies.
I just think that's a great point that Erica makes about thinking about essentially the trade-off, right? And because we're faced to this moment with really important trade-offs, and therefore we have to orient ourselves in these questions. And to tie it to the issue of bankruptcy, how bankruptcy and forbearance are sort of in this unacknowledged relationship with each other. And I think about the point that's made in this book by Joe Spooner on bankruptcy and the case for relief. He's my colleague in London at the LSE. Is to think about the type of bankruptcy and debt restructuring that corporate persons enjoy, and that if we streamlined and sort of stopped making personal bankruptcy a kind of moral judgment and instead a kind of more efficient process of discharging non-performing loans, that we would, on the one hand, relieve a lot of unnecessary suffering. Because again, the effect of, I like to talk about financial melancholia, because I think that, we've already had a Great Depression. Depression is about investor confidence, but melancholia is about what happens when you're trapped in an economy dependent on debt and you have to service your debts today, but everyone wants you to take more debt to drive demand in the future, right? And we can only unpack that if we have a more efficient mechanism for discharging, restructuring, and refinancing debt for individuals and households, small businesses, sole proprietor, joint ventures, these small debts, because we're talking trillions and trillions in secondary markets. These are small by comparison, small debts, and being able to restructure them, refinance them, and discharge, those, or easily kind of declare bankruptcy and get those debts off the books. That only, that is a temporary pain for a long-term gain because it allows for revival, and it's what makes a modern economy. Let's remember Charles Dickens and the Marshalsea and the debtors' prisons. That is not a modern and efficient economy, and that was always bringing us back to the Biden Elizabeth Warren or what used to be the Warren-Clinton debates in the early 2000s. They claimed, that this was about modernizing finance, and modernizing. Okay, let's keep modernizing then and extend some. What we've learned about financial restructuring to the personal debt, household debt kind of segments of the economy.
Wonderful. Thanks, Johnna. And Jialan, very welcome again. Great to see you now in person. Thanks for joining us. And I want to give the floor to you. We've just talked about bankruptcy and the household bankruptcy and the potential stabilizing role it can play. What do you think? Where do we stand? I guess for economists, there's always going to be also a question: what does this mean ex ante for consumer debt markets? Maybe you can weave that in, and we also have questions from the audience, but I'm going to bring them in later. But welcome. Floor is yours. Thanks for being here.
Thank you so much. And I would love to follow on to some of the comments Erica and Johnna have made. In particular, I also have some work looking at bankruptcy and COVID, and this relates a lot with the forbearance work that Erica has done, in that these forbearance measures, as well as the cash stimulus measures, have prevented those delinquencies and financial distress from getting into the bankruptcy system. And the big surprise we found is that bankruptcies have dramatically gone down in 2020 because it was kind of caught before it reached sort of the last step of bankruptcy. But, just to be a slightly provocative here, I also want to throw out one other thing, in that, a lesson that I've learned from studying the 2005 bankruptcy reform was, the motivation for that reform was that by 2005, 1% of U.S. households were filing for bankruptcy every year. And so it was just dramatic, but that I personally think that debt relief or, solving bankruptcy or making bankruptcy better does not solve the core problem, in that the reason bankruptcies were going up so much was not moral hazard or these types of explanations which were put out back in the 2000s by creditors. All these rich people are filing for bankruptcy and abusing the system. It was called the Bankruptcy Abuse Prevention and Consumer Protection Act. But it was because households were taking on so much debt. And so if we don't address the debt in the first place, it's much easier to not borrow in the first place than to borrow unsustainably and then have to figure out some way to take care of that, which of course will lead to losses for creditors, which they don't like, and other policy implications. And if we don't address the reasons why households are borrowing and whether that's too much or not, then I don't think debt relief or reforming the bankruptcy system is going to solve the problem.
Right. Let me come in with one question from the audience, because I think it's very topical. Is from Alan Solo. Isn't mortgage forbearance simply postponing the problem right now? How do borrowers bring their home loans current in the situation right now? So are we just kicking the can down the road without actually solving the issue? Anyone? I'm just throwing in the question.
Yeah, I think that is a very good question. That is closely related to the issue I brought up, right? Is essentially a forbearance program just postpone all of the debt payments, and eventually, if mortgage borrowers want to become current and want to continue with their mortgage loans, they do need some modifications. They either need to make all of the missed payments immediately, or they can negotiate or renegotiate the contract terms with their servicers so that they have a new mortgage repayments plan. The question is, how much capacity do those servicers have in order to modify all of the mortgages they have? And I think that is definitely a big issue that we need to be concerned about, because those shadow bank servicers have already, provide, missed payments for a year-long forbearance program. And whether they still have capacity to modify those mortgages when forbearance program ends, I think that is definitely an issue.
Indeed, I think that's the trillion-dollar issue that those of us who are looking at these debt relief types of programs have been trying to answer. So I'll give my speculative answer to that, in that I think the answer differs depending on who it is in the economy that we're talking about. And in our work with bankruptcy and during COVID, what we found is that bankruptcies among homeowners have dropped by more than half compared with pre-COVID times. But that for renters and non-homeowners who are relatively lower income, that drop has been about 25%. So in other words, homeowners are benefiting twice as much from all of these relief, and including the government stimulus, again, direct cash stimulus as well as debt relief. And so I'm more worried about renters than homeowners, to be honest, because the job market for the relatively higher income people has also more or less recovered, but that these debt relief measures aren't reaching perhaps the poorest households. But that for homeowners, I'm tentatively optimistic that their job prospects and income are able to catch up, and that will keep extending the relief enough so that that they're able to get back on their feet. But I'm less optimistic for renters and other sectors such as small businesses.
But maybe let me pick up here and ask Johnna. Also, I've done some work on sort of the distributional question of household debt. And if I look at where most of the debt is, it is not with the very poor people. It is with the middle class, broadly defined. We can go into the details. But so from a distributional point of view, and I think what Erica and Jialan also just said, it's not clear that we're actually helping the poorest when we do large-scale debt relief. How do we think about that? Should these households be? Are these the ones that we have in mind when we design policy?
No, and I think that the distributional question is the most interesting one, isn't it? Because debt does a very funny thing to inequality. It sort of makes debt makes those that are wealthy wealthier. Debt is a vehicle for wealth generation. Whereas, depending on some magical point we haven't quite realized that it moves from being gold back to some more problematic, it can be benign. And then as it goes lower down the distribution, become more problematic. What I'm interested in, and I think, it is more indicative of the distributional issues around debt, is the terms of credit, right? Is the rate at which people have access to what are historically low interest rates. Again, negative real interest rates, depending on your tax filing or what status you have. But again, very, very low for the very wealthy. So a $50 million loan, you can get it under 1%, but $50 from the payday or the auto loan logbook, you're going to pay many hundreds of percent. So again, it's not always the amount of debt that's the issue, right? I mean, whether you're, it can be a very small amount indeed that is very toxic and causes a great deal of harm. So if we take the idea of housing, right, the question here is more about what is the point of finance? What is finance doing here? What is the technology? And we're very clear. American mortgage markets are very clear from the 1930s. These kind of 30-year mortgages, these long terms. This is about securing a dwelling, housing, and spreading the costs out. But what we see now is a very different picture where people, debt is the only way they can access housing, and servicing that debt is the only way they can protect their savings and their housing, because you can't, walk away and keep your capital, right? So we've tied all of their values. One non-financial asset will be the sum total of somebody's financial security. Yeah, that is a priority payment until it absolutely isn't, and then the next step is what? Homelessness, because once you're going bankrupt, how do you secure private rented, accommodation? So you see, debt can be an agent of wealth, but it can also be the agent of misfortune. And that's the distributional effect. And that's a puzzle. I don't think empirically we have the answer of we crack that formula. At what point, with all factors considered, does debt start, move from being benign or a positive force to being more detrimental and harmful? But I think the issue, tying back to time lag and, kicking the problem into the future, I think that there is, the issue is how are people servicing it? We can have these long-term, we saw since 2008 that people will go a long time. So maybe immediate figures, in COVID, maybe people had more of a cushion, maybe new strategies, forbearance, they've sort of making do. But there is another longer issue, which is how can these people take on more debt to grow, right? Maybe they can service what they have up until now, but do we have a growth model of them growing that doesn't mean they have to take on more debt? So we'll still encounter the same problem. We see, I don't think it's like we're stuck in a linear thing. I think we're stuck in a loop, and we just keep going round and round. And it's about breaking that sort of cyclical cycle that we're in at the moment, more than thinking about what we deal with in the short or the medium or the long term.
Well, I guess one good point, like Johnna mentioned, is there is a distributional effect of debt. But on the other hand, I do still think debt relief, those type of ex-post debt relief matters a lot, especially during a crisis, because, for example, there are a lot of debt losses due to foreclosures, like, for example, if we're talking about mortgage, right? So it is true that those high-income borrowers may get more debt relief in terms of dollar amount because of their outstanding debt balances before the COVID-19 pandemic. But it's also true that, this debt relief program can help us stabilize the economy. I think that is something that we need to consider when it comes to think about the effect of debt relief during a crisis.
Yeah, I would just come in with one point about toxic loans. That this is the logic that they used for toxic debts in 2008, which is, there might be some, illegitimate claims, and there might be some, but by targeting it this way, we can get rid of all of the toxic debt and some of them that's not. But ultimately, it's, we need to find some more kind of precision-based way to target those debts that are actually causing problem.
Well, I think that, despite the challenges that Erica mentioned, which I absolutely agree with, of how do we service all of these, kind of forbearance plans, I think that we don't like to give credit to Congress or to the Treasury Secretary and whatnot, but I think we really have learned a lot of lessons from the last financial crisis in the amount and the immediacy of things like forbearance that we put into place. And I think many policymakers were really afraid that we would see a mortgage crisis and financial crisis on top of course, the public health crisis, and that these measures were put in place. So, with the idea that, we are doing a lot, and we have learn lessons from the last crisis. But at the same time, I just want to bring things back to the idea, that we've talked about of inequality, that debt helps, wealthy upper middle class homeowners, and of course the much wealthier, build assets, but that in the subprime crisis, many people purchased homes and put all of their life savings in it and then lost their home, and or even worse than if they had never purchased a home. And I don't think that we can address the debt crisis without addressing inequality, because debt is being used, in different ways, that it helps the wealthy, and that the wealthy, with the savings flood of the rich and that literature, the wealthy are actually lending to the poor and are, that exacerbating inequality. I don't think we can address that through debt relief alone.
Yeah, can I just come in? I really agree with that point, because the point about, it can't be it can't just be one off or this kind of package because of COVID, because ultimately it has to be the agent of change, because otherwise, again, we get stuck in the same loop. So I think, it's important to think that, these measures, although needed in an emergency, we're almost living in, this regular phase of emergency will just come up again because, we're just feeding the same cycle of boom, bust, bailout, some austerity, some monetary policy, some more stimulus. So we'll just keep going down this path unless we use debt relief as a way to deal with the larger structural issues.
Fascinating. I mean, that brings me to a point, shifting a little bit the focus, but there's always some person and some economist in the room who says, but who pays for it? And I'm just going to be that person now. But who's going to pay for this? And how do we think also about the equity of the distribution of the costs and how we think about it? I think Jialan mentioned the savings glut of the rich. And the first row, and there's lots of questions here from the audience that I'm trying to sneak in through the back door as well. Who holds these assets? And how do we think about, is there an incentive for loan services to modify these loans? Who do we ultimately want to bear the losses, especially in a system where maybe the banks are no longer that central to the intermediation process, where, in the old days, one could have said, well, the banks have to swallow that, and then they extend it over years and years, and in the end, it will be fine again, although obviously there might also be side effects of that kind of dragging them, or like giving the cost or letting the banks swallow up the cost. So how do we think about who pays for it, and how could we design a mechanism to make that actually work? Unless your answer might be, it should be the government's role to pay for it. Or do we bail in the creditors? Question to all of you. Feel free to shoot.
Well, we've had this discussion a lot. So one thing I've been doing during this current COVID crisis is I've been a part of a working group of law professors as well as finance and economics academics to think about how, who do we push the losses to? And one framework we've been thinking about is, you want to push the losses to more risk neutral parties and, kind of parties that are going to, so you want to, the losses, fewer losses for those who will spend more to stimulate the economy. So in other words, one way to think that you want to push losses from consumers to the banking sector, and maybe even from the banking sector to the government, because ultimately who's the most risk neutral is the government. And that was kind of our framework, that even between consumers and landlords, that maybe a landlord is relatively wealthier and more able to bear those losses than an individual consumer, for example. But there are limits to that framework. And so I think that, maybe some risk sharing on the part but we also don't want to cause a financial crisis. And even though households and banks have entered this crisis in a much healthier balance sheet position, we certainly don't want to collapse the banks, but some risk sharing between the banks, and ultimately probably the government will be footing a lot of the bill. And then that leads to questions of inflation or, too much government debt as well.
I do want to add, two facts to this discussion. I totally agree with Jialan said. All of the financial intermediaries entered this pandemic was much better capitalization to begin with. There are two facts from our work. One is we actually found about 1/4 of the total forbearance were provided by private sector instead of the government mandates like the GSE loans. And so I think one thing is, servicers do have incentive to provide modifications and forbearance during the crisis because they do want to recover some of the payments. They do not want to simply just, declare bankrupt. They do not want to simply just force the borrowers to go delinquency and then foreclose the whole houses. And so there are some, benefit from this private risk sharing between servicer or lenders and borrowers during a crisis. That is fact one. And fact two is ultimately, it's about who provide funding to those shadow banks, given that they are servicing 50% of the mortgages in the US. And so one of my work showed that actually, banks provide 80% of the short-term funding to those shadow banks. So eventually you may think, okay, it is true that shadow banks are servicing all of the mortgages, and also they are doing that for the GSE, the Fannie Mae and Freddie Mac, and also the Ginnie Mae. Ultimately, the funding is from the banking sector. And ultimately, if the banking sector does not have enough funding to provide to those shadow banks, and if they withdraw from the funding, the short-term funding market, then ultimately who provide funding to shadow banks? I think it goes back to Jialan's point that ultimately it's the government.
Yeah, no, I would only add to that to just focus also, instead of just on the institutional dynamics, right? Again, I find it truly fascinating, if we could ever map just the scale of interlocking balance sheets here. From one loan, from the originator, the absolute originator of the loan, the account holder, all the way, to the parceled up income payments, debt repayments as income. And that's where I want to end, the ultimate end. Who pays is whoever is invested in fixed income securities. If we're talking about backward looking debt forgiveness, right? That's who ultimately pays. The person who holds the piece of paper that says I'm entitled to 30 years of interest payments on that mortgage, or I'm entitled to 10 years of loan payments or student loan or whatever, that's what they own, is all kinds of legal claims on people's income. However many institutions that passes through, again, I'm not, I think following the trail too closely and feeling like every counterparty, every person who charges a fee in this transaction might only enable this highly complex, really this system that hasn't really gained any more resilience, in the 13 years since the crisis. They still have these fragile interconnections as they sell assets and repackage assets many different ways. It's still just one loan. You can get insurance on top of it and risk premiums and so on, but it's one originator. And again, I can understand the interlocking balance sheets, but it's really just one loan provider and who, whatever the value of that asset is in the market, and it's the one holding that will have to pay. But again, we must ask ourselves a fundamental question about the structural power of finance. Let's be clear. This money originates at near 0%, if not negative real rates. And by the time how many institutions it must pass through before it becomes a loan to be offered to a consumer, and then how many more transactions is made until it's an asset freely floating on global debt security markets. All of that cannot be guaranteed profit for anyone. Every business incurs a loss. There is a downswing at some point. And if we've had 25 pretty much uninterrupted years of returns on retail loans, any risk profile could say you have to eat some loss at some point. And there is an element of fairness to that in the sense of a balancing, in this sort of equilibrium frames. We bailed out the supply side, we bail out the demand side, and we're hoping to find balance. So I just think that really when we think about who pays and risk sharing, getting too bogged down in the institutional configuration, might inadvertently enable this complexity to continue, rather than, maybe having more of a reckoning between the liabilities and the assets, and saying those who hold the assets will have to take a haircut and let that be it.
Well, I want to follow on briefly, I think, to Erica's point in that I think that banks are also a sector that we don't normally give credit to. But I think that, just to echo the idea that there has been a lot of private renegotiation and forbearance during this crisis. And I don't think there has been research like Erica's for the last financial crisis, so we don't fully know. But my guess would be that there wasn't as much, that the creditors didn't see as much in their interest to offer plans directly to borrowers, and that I think that they were wrong in a lot of cases, that allowing a huge community to all go into foreclosure is terrible for the banks and for everyone else. And that I think that even private institutions have learned from that. And onto Johnna's point, in terms of systemic risk, I think that we are seeing, and the Fed intervened in financial markets very early last March to prevent financial crisis like we saw last time. So I think that, we have learned, we have learned some lessons, and that the banking sector and finance sector don't look like they're not my top priority in terms of fears at this stage in 2021.
Let me play devil's advocate just for 1 second. Is there a chance that a more, call it, generous consumer bankruptcy regime actually makes business cycles more volatile, because lenders will anticipate when the downturn comes that they will have bigger losses and they will cut down very sharply, very early on what would otherwise be like a consumption business cycle smoothing with ongoing lending. So we might end up creating the opposite of what we want, namely a more volatile income and employment situation on the part of households. I'm not saying that's necessarily the truth, but I want to see if there is obviously people will factor in such rules ex ante, and what might be, side effects, unintended consequences of such a shift that we don't think about yet.
I think that's a great point, and I'll follow on to that with 2 responses. On one hand, my main thinking has been in the opposite direction, that currently our debt relief policies don't take into account the business cycle, that if you allow tons of consumers to fail at once, during a crisis, we might actually want to make bankruptcy a little more generous in a crisis than in a non-crisis, in other words, because the effects for the macroeconomy are better, that we, want to relieve more debt in a crisis to stimulate the economy and to put people back on their feet who lost their jobs for reasons that are unrelated to their personal decisions. And, Adrian Auclair and Paul Goldsmith-Pinkham have some work on this that suggests that, if anything, bankruptcy during the last crisis acted a little bit as an automatic stabilizer to help boost consumption because it allowed households to write off their debt. And we, of course, do see kind of counter-cyclical bankruptcy rates, that it is true that in general, more people file for bankruptcy during recessions. But as you were mentioning, and the credit cycle is very vicious. So we were talking about inequality and kind of the viciousness of credit when it comes to certain factors, and that you're absolutely right that credit disappears, much like liquidity. Credit disappears as soon as we need it. So as soon as you lose your job, no mortgage, no credit card. So those are the times we need credit the most. And it's exactly during crises and downturns when people need the most credit that they actually can't access. And we do see creditors cut their credit lines and do all that. I have not thought through whether kind of cyclical bankruptcy policy would lead to those types of incentives. But right now, I think my main point is that our bankruptcy policy doesn't take into account the business cycle at all. And perhaps we should at least think about it.
Just to follow up on Jialan's point, I think this is a very good point. In mortgage market, after the financial crisis, people have been, a lot of academic scholars have been thinking about how to design the mortgage market such that we can provide ex-ante debt relief solutions. And one of the solutions they come up is to benchmark all of the payment to the underlying economic conditions. And of course, they also talk about the shortcomings of such ex-ante debt relief solution is that there may be some errors, and the errors in understanding the underlying economic condition may hurt the effectiveness of such ex-ante debt relief compared to ex-post. But I definitely think this is one of the solutions that people need to think about or revisit at least after the Great Recession.
Yeah, no, I think that's a very interesting point, Jialan. I like the idea that you could maybe there could be some causal mechanism that could be activated. I think that's quite a creative idea. That's worth considering. The only thing I would add to the question of wouldn't we just exacerbate the business cycle? Is really just to look at corporate bankruptcy. I think that's the model. The idea that if corporate persons are sort of advancing their legal personnel, their legal status, as should, legal persons be able to emulate them in sort of financial terms, because really what we don't want, and I've heard many times in the talk today about, the purpose of finance, is to provide a home, not necessarily take one away. It shouldn't be the financing itself that is the cause of homelessness, right? It's always meant to be that's the consequence of something else rather than its cause. So again, here I think that while it might make it worse, leaving it as it is insufficient. So I think that would be more my point, is that again, we have this buildup of debt. Having more stringent bankruptcy, hasn't made it better. It's just created more factors that can exacerbate its downside.
Right. Let me one quick follow on, and then maybe move on to another topic. It sounds a lot like we want to make debt more like equity. That when things are bad, sort of the lender, also becomes a little bit more of an equity holder, but don't we risk losing the advantages of debt? Will it become more expensive? Will people lose possibly access to home ownership if that rigidity of debt is, we give that up? I'm just throwing it out there.
Maybe they have too much debt. So, I guess just to summarize my response to your last point is that maybe, kind of counter-cyclical debt relief policy can help smooth out the business cycle instead of, as you were mentioning, exacerbate it. But maybe one way to smooth out the business cycle and not exacerbate it is that we see these boom-bust cycles. And there's been a growing literature on this, that booms in consumer debt lead to unsustainable demand, which then makes recessions worse and lead to financial crises and lead to prolonged recessions. And so maybe, again, we should address the root cause, not necessarily debt relief, but debt origination, that maybe we should, tamp down booms in huge amounts of borrowing so that we don't need to then deal with it in ways that, as Erica mentioned, are very tricky. And maybe that's a way to address these, kind of volatile business cycles.
I think I would add being a little bit more provocative, is to say, well, with interest rates, as it were, debt has already destroyed savings, right? We don't have small savers anymore, right? If you had, $40,000 came from the sky, or 40,000 pounds, right? The very last place you put it is in a bank account, an interest-bearing savings account, because, there would be no purpose. So debt's already destroyed savings. For most people, right, nearly 70% of households in America, their house is their only asset, and it's a non-financial one. So, and again, leveraged or not, all they're trying to do is pay down debt in order to have that one asset. So it already is just, sort of destroyed, that kind of collective provision. So it is already well on its way to for households to not be anything like what debt is supposed to be. Investment. Here I would point to student loans, right? Student loan is a ninja, right? It's a ninja loan. No income, no job, no assets. I'm going to give you a speculative loan on your potential future earnings and hope to get it back. So again, that's not investing in physical infrastructure, to earn money that you pay back, right? This is an inherently speculative loan that is backed by the governments of the advanced world, which again leads to distortion. So I would just say that debt is already well on its way to being something closer to equity. And it's that blurring of the line that I think complicates the moral and political registers, that make it hard to take sides, right? Because this negotiation has been happening via financialization, as we've sort of made this asset economy, that's where debt is always tied in. And that's the other point, is debt is a very lucrative asset to invest in. Debt securities markets, mortgage, these are grade A investment products, right? And what's really being monetized here is an interesting question, a philosophical one. But in that respect, again, it's already made that full conversion as AAA, investment grade for many pension funds and so on is secure. And again, that's not unproblematic, I think, when we think about, what is debt really being used for.
Let me come to maybe a last round of questions, and there's also some questions that have come from the audience that I want to at least touch upon in this last round. Is if we agree on this round of sort of more of debt relief and being an instrument to deal with both the business cycle but also the over indebtedness of households, what do we do ex ante? How do we think about the following question? What makes people borrow so much? And should we limit that? And how can we do that without, I think, Johnna, you said that at the beginning, keeping potentially the good side of debt, which is an access, and it was an access for many middle-class families to build wealth, to get on the housing ladder, and to have the life that, frankly, they probably want to have, and the dark side of debt, if you will, which gets us into messy crises and very bad economic situations. So, how do you think about that? Like, for the next cycle, what do we do ex ante? Do we limit, depending, I guess, on what we think drives the borrowing, but do we intervene? Do we limit borrowing? What do you think?
This is always a trade-off, right? We always have a trade-off. If you limit borrowing, then how can we boost economy? And if we don't, what about the financial stability? So I think Johnna probably has something to say. And
well, I think that there are a lot of answers to that question. I do think, to me, the core question is to understand these historical patterns and how did we get here in order to know how do we get out. And I think a one-time debt relief is not going to answer it, because we have to address what are the reasons we are borrowing so much and how do we realign that. And I think one thread that I think absolutely must play a role. I'm sure it's not the only one, but if you look at the trends of household debt in the United States, really started to really shoot up around the 1980s, and has just continued a sort of convex trend since then. And I think financial deregulation likely plays a large role, and it happened in many different markets. So the credit card market, allowing interest rate exporting across states, many different waves of deregulation. And one thing you've seen is that I think on net, of course, many individual borrowers were able to buy a home or were able to get a loan to get an education to are benefited. But what I'm seeing is that wave of financial deregulation coincided with a huge rise in inequality. And that on average, I don't think middle-class households or those at the lower end of the distribution have benefited from this increase in debt. And I'm drawing very, very broad connections here, but maybe we should rethink, kind of some of those, because we kind of deregulated. So let's revisit where all of those deregulation waves sensible in every single specific debt market. And I think we need to be careful with regulation and in addressing the mechanics, but maybe rethink those regulations.
Yeah, I would only add to that again. What makes something good credit? When does good credit become bad debt? Where is that point? And to think, wouldn't it be great if the Council of Economic Advisors, the Federal Reserve, the central banks, had this, instead of price stability as a point of consideration, for the household sector as well as other sectors, because I think that that understanding, the drivers, what drives people to borrow. Again, there's so many debt products, right? So. Right. Sometimes it's income. So again, Rajan's thesis on the whole, again, at the median, at the central tendency here is that it is income stagnation. But again, the distributional question factors in as well, in that some people have, again, very small but high cost loans that are difficult to service, and others have wealth or debt that generates wealth. But again, to understand that dynamic and actually say that, should debt be contributing to inequality, or should it be contributing to productivity gains, or should it be contributing to green renewal? Because again, the trade-off for us, there's also trade-offs that lenders are engaging in, right? Is it easier to just make another portfolio of credit card loans, but because that's lucrative and profitable? And if that wasn't as profitable because of regulation, for example, would I then invest in wind farms and renewable resources? So the trade-off is not just for policymakers and for individuals. The lenders themselves, the structure of the market incentivizes them to continue down this road of trying to, of maintaining huge portfolios and very high cost household credit, because, they want to maintain their profitability. If it became less profitable and it could be diverted elsewhere. So I think that that's really important, that we're all engaged in trade-offs, and that there's a real governance issue here, of the monetary authorities as well as the government, not just purely sort of fiscal issues, but also kind of monetary as well. So in that respect, money needs to become much more than debates about the deficit. I think that's really, a great place where we can start, because that really, I think, frames everyone's thinking about when good credit becomes bad debt is whenever we report on the deficit. It sort of frames their thinking. And so we can really, open up that discussion to be more about, debt, not just of the government. I always like the parallel that they always say the government's like the household, but they never actually talk about the household and what they're enduring. So, having that wider discussion, in line with, again, issues about how do we create a regulatory system that actually takes some of the heat out of these swings in the market, it would be interesting, certainly, and definitely a way forward.
Yeah. I think just one quick point to follow up is whenever we have a stringent regulation on the traditional banking sector, we always have a loophole, right? We have seen before crisis and after the crisis there is a shift from traditional banks to the unregulated shadow banks. And if we put more regulation, and then the credit supply will switch from regulated sectors to unregulated sector, I do think that will further contribute to the increase in debt and what type of debt there is in the society.
That's absolutely right. And so my personal preference is targeted and smart regulation that takes into account exactly what you said, that there's a shifting of credit, and to address each individual market, and to kind of surgically address what are the causes and how do we define good versus bad debt in a particular market. Student loans, for example, suffers a lot from the decline in public education funding, and that's why people are taking out so much. And we have to address those causes within each individual debt market. And as a former policymaker, I can say that we don't always get that conversation. We don't really target it very precisely, but that would be my view on how we can start to address how do we rein in this debt, and separate those good and bad potential factors.
Wonderful. We have to come to an end, but I want to ask each of you one simple and quick last question. And I think we need a reasonably short answer. So assume you are White House and you could do one reform, but only one reform in that area. What is it that you would implement and think, because you would think that has the biggest impact right now and would help the country, the economy most? Maybe starting with Erica, if that's okay, and then Johnna, and we finish with Jialan.
As I said, I will start with the modification and servicer. I think it is important for those servicers to really have capacity to modify all of the mortgages as we're approaching the end of the forbearance program. I think that is something that we need to be thinking about.
Okay, if it were me, I would extend $30,000 US 0% refinancing up to the limit of monetary refinancing that's been given already in the past 12 months, just to households that are struggling with their debts. They can nominate their own and refinance at 0%. That would be, what I would do if I was given the keys.
I'll pick something really simple that I'm very confident will benefit households, which is to make bankruptcy simpler and less expensive. That U.S. households have to pay $1,000 or $2,000 just to access the bankruptcy system, and that doesn't make sense for bankrupt households. And that the 2005 law made things too complex, too much paperwork, and that's not really benefiting anyone other than lawyers.
Thank you all so much. I enjoyed this a lot. This was very informative, and I learned so much from that. It concludes now INET's Dead Talk conversation. And thank you also to the audience for joining us today. To view past episodes, you can go to the INET website, or you can also click on the Watch All Episodes button to the right of this video. And please follow INET Live, the INET Economics, to hear about new episodes coming up and information on upcoming events. So see you next time, and thanks again to you, Johnna, Jialan, and Erica,